Stocks that pay dividends are fantastic, and it's certainly a great place to start, but what you really want are stocks that increase their dividend payments year after year, because that's what really makes a dividend snowball effect so powerful. And in this video, we'll be talking about 5 attractively valued stocks that are giving you a pay raise and have announced big dividend increases so far in 2023. But before we get to that, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks, and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. But anyway, getting into the first stock of the day, we are talking about Qualcomm, QCOM, who announced a pretty sweet 6.7% dividend raise on March 8th, so a few months ago. And at the time of the announcement, they had a forward dividend yield of 2.68%. And if we look at the rest of the dividend stats, we can see that the yield today is almost exactly identical, 2.69%. And the rest of the dividend stats are looking great. Super low payout ratio, below 30%, with a decent growth rate, about 5.5%. And it's good to see that their most recent dividend raise is a bit higher than this, so above the average. And they've been growing this dividend for nearly 20 years straight, so that's a really solid track record. And taking a look at their share price performance, Qualcomm has absolutely been pumping lately, guys. They are up over 17% just in the last 30 days, which is crazy, which leaves them with a year-to-date gain of about 14%. But if we zoom out a little bit more across the last 365 days, they are down 5%. And looking over there at the 52-week range, they are hovering right at about the midpoint, but still, the valuation isn't too bad. Taking a deeper look at this, they have a forward PE ratio of 14.38, which in its own right is pretty solid, and this is actually about 17% below the company's 5-year average. So on a relative basis compared to their historical PE ratio, it does look to be a little bit discounted. And scrolling down, taking a look at the forward price to cash flow, 11.74, really nice, like to see that, and this is 23.5% below the 5-year average. But anyway, moving on to the second stock, we are talking about Comcast, who also announced a pretty nice dividend raise right at the turn of the year. They raised the dividend by 7.5% on January 26th, and at the time of announcement, they had a forward dividend yield of 2.89%. And once again, today, almost 6 months later, that forward dividend yield is right at about the same point. And Comcast also has a pretty low payout ratio, just under 30%, with a very nice 5-year dividend growth rate, 10.67%. And their most recent raise is a few percentage points below that, but it's all good. And they've been growing this dividend for the last 5 straight years. And it's kind of interesting. The dividend stats we're seeing here from Comcast are like the exact opposite of what we'd find with some of the other popular telecom stocks like AT&T or Verizon, who don't have low yields and high growth like what we're seeing with Comcast, but instead have high yields and low dividend growth, if any. But anyway, taking a quick look at their share price performance, they are basically breaking even in the last month. They're only up 0.8%, but looking at their year-to-date performance, it is very nice. They are up 14.4%. And once again, zooming out across the last 365 days, they are only up about 1.25%. So really nothing crazy going on there. And looking at the 52-week range, Comcast looks to be on the upper end of that, but still, the valuation is not too bad at all. These guys have a forward PE ratio of just under 11, so that's pretty low in its own right. And this is also 25% below the company's 5-year average PE ratio. So definitely it looks to be at a discount compared to where it usually sits. And scrolling down, looking at the forward price to cash flow, this is extremely low there in the single digits, 5.89. And this is also about 23% below the company's 5-year average. So once again, it appears to be at a decent discount compared to its historical averages. But anyway, moving on to the third stock of the day, this one is Williams-Sonoma, WSM, which is a company that I've been talking about a bit more frequently lately here on the channel. And on March 16th, Williams-Sonoma announced a really nice 15% dividend raise. And they also approved a new $1 billion stock repurchase plan, which is a good time to do it because the valuation is looking pretty sweet right now. And at the time of this announcement, they had a forward yield of 3.04%. And if we look at the rest of the dividend stats today, the forward yield is a bit lower, sitting at 2.87%, which is due to a recent jump in share price, which we'll take a look at here shortly. But looking at the rest of the stats, guys, the payout ratio extremely low, about 20%, with a really nice 5-year growth rate. This is right in line with the dividend raise they announced in March, so that's pretty good to see. And they've been growing this dividend for the last 16 straight years. Now, taking a look at the share price performance, like I said a moment ago, they experienced a pretty nice jump in share price recently. They jumped 10.6%, which I'm actually not too thrilled about because I've been planning on adding this company to my portfolio for some time now. I've just been keeping my eye on it lately, and I would have preferred to start the position before this 10.6% jump, but such is life. But anyway, this leaves them with a year-to-date performance about 10%, just under it, and in the last year, they are only up about 4.5%, so really not too bad there. And I will say this, even despite the run-up in share price, the valuation's looking pretty good. I mean, their forward PE ratio is there in the single digits, 9.24. Can't really complain too much about that. And this is also nearly 30% below the company's 5-year average. So there's definitely still room for the share price to come up. And the forward price to cash flow is looking great too. This is pretty low, 7.45, and this is 23% below the company's 5-year average. And with that said, I'm still planning on starting a position in Williams-Sonoma sometime soon. I still kind of want to keep my eye on it, but I might just start a small position, kind of start building that out and dollar cost averaging into it, starting either this week or possibly next week. I'll definitely keep you guys posted. But anyway, moving on to the fourth stock, this is Discover Financial Services, who announced the biggest raise so far, guys. 16.7% they have boosted their dividend by, and they announced that on April 19th, just a couple of months ago. And like Williams-Sonoma, they also approved a really nice stock repurchase plan, except theirs was for $2.7 billion, which is fantastic. And at the time of the announcement, their forward yield was 2.65%, which is a bit above where it's currently sitting at 2.45%. But look at the rest of the dividend stats, guys. These are looking great. The payout ratio is the lowest we've seen all day, 16%, and the 5-year growth rate is fantastic, 12.3%. And actually, the recent dividend raise of 16.7% is considerably above the 5-year average, and that's really good to see. But anyway, they've been growing this dividend for the last 12 straight years, so some good consistency there as well. And taking a look at the share price performance, Discover, guys, has just been on a roll. Look at that. In the last month, they're up almost 20%. And this leaves them with a year-to-date gain of about 18.4%. So all of their gains so far this year, and then some, have come just in the last 30 days. And the same is true here in the last year. They're up about 25%. Most of their gains have really come just in the last 30 days, but very impressive. And taking a look at the valuation real quick, this is looking great. The PE ratio is only about 8.5, and this is 25.5% below the company's 5-year average. So that's looking good. And looking at their price to book real quick, 1.97. This is nice as well. And this is about 7% below the company's 5-year average. But anyway, moving on to the last stock of the day, we are talking about AGCO Corporation, which, in case you've not heard of this company, it's a manufacturer of agriculture equipment. So they make things like tractors, watering systems, feed storages, stuff like that. But anyway, AGCO announced a crazy near 21% dividend raise at the end of April on the 27th, but their yield is pretty low. I will say at the time of this announcement, it was only sitting at 0.95%, but it looks like they also pay a special dividend, which is going to push that dividend yield up a lot higher. And looking at the dividend history here, it looks like for the last 3 years in a row, they've paid a special dividend, which has gone up every single year. And the most recent one right here was for $5 per share in May. And with this $5 special dividend, that should put the yield up closer to about 5%. That's pretty dang solid. And the rest of the dividend stats are not too shabby either. Look at that payout ratio, guys, only 7%. It's not too often that you come across a single-digit payout ratio. And the 5-year growth rate's really nice too, 11.73, and the recent dividend raise is almost twice as much as the 5-year average growth rate, so that's really good to see. And they've been growing this dividend for the last 9 straight years. But anyway, taking a look at their share price performance, they're up about 4.4% just in the last month. Really not too bad, but they are still down about 5.25% year to date. And if we look at their performance over the last 365 days, they are up about 17.3%. So they're doing pretty good there. And they are sitting somewhat closer to the top of their 52-week range. But still, the valuation is looking great, guys. Their PE ratio is very low, 8.44, which is 41.5% below the 5-year average. So that's looking sweet. And if we scroll down, the forward price to cash flow is also looking good, 7.16, nice and low in the single digits. And this is about 27.5% below the 5-year average. At any rate, I think all of these stocks will be pretty solid compounders for years to come. And if you want to hear about a few more that are in the same boat, then check out this next video right over here. In this one, I'm telling you about my favorite stocks that you can buy and hold forever. And I actually have all of these stocks in my portfolio. So click right over here to check them out, and I'll see you in the next one.